You were tuned in to the 5-Minute Signal, Business and Wealth. I am Vivian Thorne, economic strategist. This is not a finance podcast. This is a blueprint for building and defending your economic fortress. We don't do speculation here. We do strategy. 5 minutes on the clock. Let's get to work. Yesterday, the S&P 500 delivered a stern lesson to the complacent. After months of chasing the phantom of 7,000, the index retreated, closing at approximately 6,939. This 0.43% decline is not merely a decimal point adjustment, it is a rejection of a level the market was not yet ready to colonize. We saw a brief, desperate spike towards 7,002 earlier in the week, but that ground was quickly surrendered. The momentum that fueled the early January rally has collided with a wall of reality. While the broader uptrend technically remains intact, the greed phase of this cycle is visibly fading, replaced by a neutral to bearish bias as we head into the first weekend of February.
The drivers of this pullback are threefold and formidable. First, the nomination of Kevin Warsh to lead the Federal Reserve has introduced a new brand of volatility. Warsh is a known quantity with an unknown mandate, a pragmatist who understands the dangers of asset price inflation, but is being tapped to steer an administration's desire for growth. This has ignited the US dollar and sent precious metals, including gold and silver, into a sharp unwind as traders price in a more hawkish, dollar-centric regime. Second, we have reached the point of AI exhaustion in megacap earnings. Microsoft's cloud growth failed to satisfy the stratospheric valuations placed upon it, and even Apple, despite posting a record-breaking quarter, saw its shares dip. When record performance results in a sell-off, the market is telling you that perfection is already priced in. Finally, the spectre of sticky inflation persists, with markets now bracing for a hold stance rather than the series of cuts once promised.
Why does this matter to you? Because the 7,000 level is more than a technical resistance point. It is a psychological boundary. Crossing it requires a consensus of conviction that simply does not exist right now. The tech sector, which has been the sole engine of the S&P's ascent, is beginning to fracture under the weight of its own capital expenditure. The massive investments in AI infrastructure are finally being met with the cold question of when is the ROI? When a company like Microsoft plunges after beating top and bottom lines, the game has changed. The market is no longer buying potential, it is demanding proof of monetization. If the engine room of the economy is stalling at 7,000, your economic fortress must be prepared for a period of structural consolidation. The hard truth is this: in 2026, good is the new bad. We have entered a market environment where flawless execution is expected as the baseline, and anything less is punished with extreme prejudice. Many of you have been riding the momentum of the Magnificent Seven for years, believing that these giants are immune to gravity. They are not. The fracture in tech earnings suggests that the AI premium is being reevaluated. Furthermore, the nomination of Kevin Warsh signals an end to the era of predictable, dovish guidance. If you are still operating on the assumption that the Fed will always step in to save the equity markets, you are building your fortress on sand. The Warsh doctrine will likely prioritize dollar stability and balance sheet reduction, which are inherently hostile to overextended equity valuations. Hope is not a strategy, and the hope for an easy 7,000 breakout has been deferred. To defend your capital, you must take the following 3 tactical moves. 1. Audit your tech exposure immediately. If more than 30% of your portfolio is tied to the AI boom through megacap tech, you are over-concentrated in a sector that is currently being repriced. Rotate into defensive positions or high-yield cash equivalents until the 7,000 level is reclaimed with volume. Tighten your stop losses at the 6,835 mark. This level represents the 50-day moving average and a critical rising trend line. If the S&P 500 breaks below this support, the neutral bias shifts to confirmed bearish. Do not ride a consolidation down into a correction out of loyalty to a ticker symbol.
Prioritize liquidity and dollar-denominated assets. With the dollar firming on the news of the new Fed leadership, cash is once again becoming a strategic weapon rather than a drag on returns. Ensure you have the dry powder necessary to strike when the market finds its true floor, rather than being trapped in the debris of a tech sell-off. The era of easy gains is over. The era of the strategist has begun. I'm Vivian Thorne. This has been the 5-Minute Signal. Stay sharp. This program is for informational and educational purposes only. Economic strategist Vivian Thorne is not a licensed financial advisor. This content is not a substitute for professional financial, investment, or legal advice. Always consult with a qualified professional before making any financial decisions.